Well, for more on the markets and how the Fed's decision could affect them, Scott Miner joins us now from New York. He's managing partner, chairman, and global chief investment officer at Guggenheim Partners. Welcome to the show.
Hello, Rachelle. How are you?
Good, thank you. Now, as we know now, the benchmark interest rate was raised by 0.25% with another hike expected this year. What's your take on the pace of all these rate hikes?
Well, the rate hikes are coming just about as advertised. I think the surprise today was the detailed discussion around reducing the size of the Federal Reserve's balance sheet. And the market had not anticipated that. But at the same time, because the market seemed to take it so well, the bond market didn't sell off on the news of increased supply. The participants here have taken this as a positive sign, and that the Federal Reserve will successfully manage the reduction in its balance sheet without disrupting the economy.
So what's the significance of making this move now to shrink the balance?
Well, I think there are two things. One is that they are anxious to get started. Janet Yellen's term will end at the beginning of next year. I think she would be loath to leave office and not have begun the process of balance sheet reduction, as balance sheet reduction and normalization is a big political issue. I think the other thing is that they realize that some of the data that they're currently seeing, where we're having a slowdown in the rate of inflation, and we had a weaker first quarter, maybe indicates that the Federal Reserve might want to wait until December before they do this one last rate cut that they're expecting to do this year. So that would mean that we would probably start balance sheet reduction in September, and the Fed will look to ease their way into it and see how the market reacts to it.
So what aspects of the economy was the Fed really focusing in on when it was making this call to raise the interest rates and also balance its bank sheets?
Well, the first thing that the Fed has its dual mandate. And in the dual mandate, they are concerned about unemployment and also concerned about inflation. As we know from the last employment report that we got, unemployment in the United States is falling faster than they expected, which is a good thing. But the Fed is concerned that as unemployment falls, this will cause a pickup in wages, which will be inflationary. But on the other hand, the inflation data that we're getting is telling us that there are a number of factors that are contributing to a decline in the rate of inflation. For instance, owner equivalent rents are slowing down. Telecom expenses have fallen dramatically. Automobile prices are falling here. And then in the pipeline looking ahead, we have declines in oil prices, which will affect the price of gasoline and other sources of energy. So the Fed is got itself in a little bit of a conundrum in that on one hand, the unemployment rate is falling to levels that are so low that they're expecting an increase in wages to occur. But at the same time, they're watching inflation slow down. And so in terms of the real economy, it would be very difficult for them to manage their way through this without allowing either unemployment to fall too far or, on the other hand, letting inflation fall too low.
Now, the Fed did say that it is monitoring inflation rates closely at this point. How might that influence potential rate hikes in the future?
Well, if the Fed does not get what it's expecting in terms of inflationary pressures, then it's going to slow things down. And that's why I personally believe that the Fed will pass on the opportunity to raise rates in September and will look more to December to get its additional rate hike in this year. That'll give them time to look more at the data. And then if by December we're not starting to see a pickup of inflation, the Federal Reserve then I think will probably start adjusting its guidance in terms of where future interest rate increases come from, and ultimately how high will interest rates go. Right now, the Fed is projecting that ultimately by 2020, we'll see short-term rates around 3%. I think that perhaps they'll be downgrading that expectation to something closer to 2.25% to 2.5%.
Right.
But the Fed's going to need to see more data.
Now, Scott, speaking of the Fed itself, we know that President Trump had been very critical of Fed Chair Janet Yellen and called the central bank political. But on Wednesday in the press conference, Yellen said she intends to serve out her term, and she also defended the credibility of the Fed. Does the Fed have a credibility problem?
Well, I think that the Fed has a credibility problem from the standpoint that it hasn't been aggressive enough in terms of normalizing the balance sheet. And so this is one of the reasons why I think that the chair is anxious to get started, to show that she is a credible leader at the Federal Reserve. I think that also there's a question now as to whether the president wants to ultimately have higher interest rates. Given the fact that at this point the administration has not been successful in implementing its stimulus programs and tax program, I think the administration is probably going to get more concerned that the economy is slowing, as we're starting to see evidence of potentially in the inflation data, and that perhaps they're not so anxious to see the Federal Reserve raise rates as fast as they had talked about during the campaign.
Well, it should certainly be an interesting next meeting. Thank you so much. Our thanks to Scott Minerd, Managing Partner, Chairman, and Global Chief Investment Officer at Guggenheim Partners.